We are looking live at ON Holding AG, ticker symbol ONON, and the stock is absolutely exploding this morning. As of this moment, shares are trading at 42.20, which is a staggering 19.95% jump, up more than $7 a share just since the opening bell. This is a massive, violent move, and it's one that is catching an enormous number of people by surprise. Because let's be honest about the expectation versus the reality here. The expectation for ON Holding coming into this morning was frankly dreadful. This stock has been bleeding out, trading down near its 52-week lows. The sentiment, especially after a disastrous second quarter earnings report, was that the growth story was over. We saw analysts getting nervous, with firms like Jefferies downgrading the stock to underperform, and even bullish firms like Truist were trimming their price targets. The chatter online, the social media metrics that analysts watch like TikTok trends, were reportedly in decline. The narrative was that ON was a fad, another premium sneaker company that had its moment and was now facing a brutal slowdown in the United States and intense competition. That was the expectation: pessimism, caution, and a lot of investors sitting on a significant loss. The reality, delivered this morning, is a third quarter earnings report that has completely demolished that bearish narrative. ON didn't just beat expectations, it reset the entire conversation. The company announced net sales that surged nearly 25%. But the real story, the number that is causing this 20% stock spike, is the gross profit margin. It expanded to an incredible 65.7%, up from 60.6% last year. That is a stunning figure for any apparel or footwear company. It signals that ON is not only selling more products, but it is doing so with more pricing power, not less. They are not discounting, they are not capitulating to a weak consumer, they are selling their premium products at premium prices, and people are paying. Net income didn't just grow, it skyrocketed, surging almost 290%. This wasn't just a strong report, it was a statement. The company showed that the fears of a U.S. slowdown were overblown by posting massive growth in other areas. The Asia-Pacific region, for example, grew sales by over 94%. And for everyone who thought ON was just a one-trick pony shoe company, their apparel sales grew by nearly 87%. This report proves diversification, it proves brand strength, and it proves profitability on a scale that few thought possible after the Q2 miss. And to top it all off, they raised their full-year guidance for 2025. This move today is the market's frantic attempt to correct its own deeply pessimistic expectations, which were proven fundamentally wrong just a few hours ago. This brings us to the short-selling situation, which is a critical piece of the story. Before this morning, the short thesis seemed pretty simple. The stock's valuation was astronomical, with a PE ratio well over 60 or 70, and its growth was hitting a wall, as evidenced by Q2. Looking at the data, the short interest is significant, but perhaps not what you think. As of the most recent reporting, we see about 14.7 million shares held short. That's about 6.4% of the float. Now, 6.4% is a notable number. It shows a real contingent of investors betting against the stock. But it's not the 20 or 30% figure you see in the squeeze plays. The days to cover, or short interest ratio, is also relatively low, sitting at about 2.2. That means, in simple terms, it would only take a little over 2 days of average trading volume for all the shorts to buy back their shares and close their positions. That's not a setup for a prolonged, massive squeeze. But here is the actionable insight, the part most people miss. The real data point to watch is the short borrow fee rate. This is the interest rate that short sellers have to pay to borrow the shares. When a stock is hard to borrow and in high demand by shorts, that rate can spike to 50, 100, or even 500%. For ONON, the borrow fee rate has been, and largely remains, incredibly low, often under 1%. It's cheap and easy to short this stock. What does that tell us? It tells us the short interest isn't a coordinated, retail-driven attack. It's mostly large institutions, hedge funds, who are using the short as a valuation hedge. They look at a PE of 70 and short it as part of a pair trade, while perhaps going long on Nike or Lululemon. They weren't betting the company would go to zero, they were betting it was too expensive. And today, those shorts are in a world of hurt. They are being forced to cover not because of a Reddit campaign, but because their fundamental thesis was just proven wrong by the company's performance. When you look at off-exchange short volume, the numbers are high, often in the 45 to 55% range. This means a large chunk of shorting activity is happening in dark pools, away from the public exchanges, which is a valid point of frustration for many retail investors who feel it obscures true price discovery. But today, it doesn't matter. The fundamentals are so strong that they are overwhelming any technical market structure games. Those shorts are getting a margin call. What's your take on the short interest? Is that 6.4% a smart hedge against valuation, or did they get this quarter completely wrong? Let me know in the comments. So what does ON Holding actually do, for those who are new to the story? This is a Swiss company, founded in 2010, that has rapidly become a dominant force in high-performance and lifestyle footwear. Their signature is the Cloud Tech technology, those little pods on the sole of the shoe that are designed to provide a unique cushioning sensation. They have built an incredibly strong brand, first with runners, then in a broader athletic context, and now as a legitimate fashion and lifestyle player competing directly with giants like Nike and relative newcomers like Hoka. Their model is built on being a premium brand. They do not want to be the cheapest, they want to be the best. This is why they have focused so heavily on their direct-to-consumer channel, selling from their own website and stores. This model, as we saw today, is what allows them to protect those sky-high 65.7% growth margins. The past performance has been a roller coaster. The company went public and was a market darling, a true growth story. Then 2025 hit, and the Q2 earnings report in August was a complete disaster. They missed on both revenue and, critically, on earnings per share, posting a loss when a profit was expected. The stock collapsed, and the narrative soured. That is what makes today's Q3 report so powerful. It's not just growth, it's a comeback. It's a turnaround story happening in a single quarter. It proves that the brand's connection with consumers is far stronger than the market believed, and that the Q2 issues were a temporary logistics or supply chain problem, not a permanent demand problem. This leads us to the future outlook, which has been completely rewritten as of 9:30 a.m. Eastern. The old expectation was a slow bleed. The new expectation is a return to high growth. The primary catalyst is clear. This company is an execution machine. The 94% growth in Asia and 87% growth in apparel show two massive independent runways for growth that are just getting started. They are proving they can be a diversified, global brand, not just a shoe company for Western markets. The raised full-year guidance is now the new benchmark. Management has put their credibility on the line, and after this quarter, the market is giving them the benefit of the doubt. The risks, however, are still very real. The main risk is macro. We are still in a difficult economic environment. Are consumers really going to keep paying $180 or $200 for sneakers if a recession truly hits? Today's report suggests yes, but that can change. The other risk is that the bar has now been raised. After a 20% pop, ON Holding is now priced for perfection again. When they report Q4, they can't just meet expectations, they have to beat them and raise guidance again. Any sign of deceleration, any slip in those gross margins will be punished severely. And of course, competition is not sleeping. Every other brand sees what ON is doing and is gunning for their market share. So here is the final reality. The market believed ON Holding was a slowing growth story with a broken valuation. The shorts believed the fad was over. The reality is that this is a premium, high-margin, high-growth brand that just hit a speed bump in Q2 and is now re-accelerated. The 20% jump today is the painful, expensive sound of the market realizing its expectation was wrong. The shorts who were betting on a valuation problem are now getting steamrolled by a fundamental performance story. The narrative has been reset. The question is no longer, is ON Holding in trouble? The question is, how high can this new momentum take them? Comment below and let me know how many shares of ON Holding you currently hold and whether this report has changed your long-term thesis on the company.